Hey Bowtie Nation, Joseph Hogue here, sick as a dog, but here anyway with your Monday market update. A very important topic this week, as well as all the stocks I'm watching and the news that you want to see for this week. So had to record this one. We've been talking a lot about oil stocks lately and energy stocks recently. Not only are the stocks up in the sector 60% this year, but they're the only sector in the 11 sectors of the economy that are up. So it would be easy to think that that all has to change next year, but we could see actually just the opposite. We could see continued strength in oil stocks and for another strong returns for 2023. In fact, forces are lining up right now that I'm going to show you in this video that could mean another all-time high for oil stocks and the price of oil. So I want to get into that. I want to get into our Monday market update and get you ready for investing this week. But first, some of you out there might know that I started actually writing and doing my stock market analysis on Seeking Alpha about 10 years ago. It was about in 2011, 2012, some of my first analyst jobs and commentary out there on the internet while I was working for venture capital, private wealth management, things like that. I've used the site since. It is kind of hit and miss with their free stuff, but I've used the premium access for a lot of their information. I'm actually going to use a lot of that in the video today, some of the information that I got from that premium content there on the website. So I was excited when somebody I used to work with there at Seeking Alpha reached out to offer this deal, this exclusive deal for all you out there in the Bowtie Nation, premium access for only $99 a year. That's about $8 a month. That's down from $239, what that is usually offered, $140 off, about 60% off that normal price. Now, actually, I pay about $140 on that. That's normally the lowest you can get the discount on that premium access, but they're offering through the link that I'll leave in the description below, $99. And you can check through. You can start the free trial. Actually, free trial is 7 days. You get to check it out, see if you like it. Absolutely free. Some of the screeners on here are really excellent. Especially, they've got a dividend screener that I use a lot. They've got some of the analysis, some of the news that I'll be sharing here in today's video. So again, just check that out. Click through, get your free trial started. If you do like it like I do, if you do want to use it like I do, then it's only going to be $8 a month after that if you use that link that I'll leave in the description below. I do want to get to today's topic though, because it is a very important one. We talked about something I mentioned last Friday in last Friday's video about the oil stocks that I'm buying and holding myself. But we need to cover this in more detail because this could be the force that pushes oil back over $100, over $120, up to an all-time high that could go to $150 and even more over the next year. Since March, if you got to understand this, since March, the U.S. government has been drawing from the Strategic Petroleum Reserve. That's the SPR, and it's basically just an underground, underground reserve of barrels, millions and hundreds of millions of barrels of oil that then we can use to protect ourselves from geopolitical events, right? So after the invasion, Russia invaded Ukraine in March and sent that price of oil up to $120 a barrel, then the U.S. has been drawing about 1 million barrels a day from this reserve to keep oil prices low. And it has helped somewhat, right? Oil came down almost immediately from that $120 a barrel, came down into the low hundreds, and now it's right around 85 to 90. A lot of these different forces are playing against oil, whereas China's slowing, the fears of an economic recession in the United States, kind of playing against that price of oil, but then of course just high demand and super low production that we'll talk about here in a little bit is keeping that price high. The problem is, how long can it protect us from all this? Okay, by mid-October here, the SPR had fallen from about 750 million barrels of oil. We had that in about 2010, right around 2015, 750 million barrels of oil in that reserve to just 401 million barrels of oil. That's a 38-year low. And while it might still seem like a lot, to have 400 million barrels of oil in reserve, the U.S. consumes 19 million barrels a day and just isn't producing enough. So the SPR really only covers about 3 weeks worth of demand. So if you got to ask yourself, what were to happen if we were to have another geopolitical event, if some of that oil supply from OPEC nations, from Saudi Arabia, from Iran, from a lot of these other countries were just dried up or we didn't have access to them all of a sudden, how long would we be able to live just off of our own oil production? And it's not very long. President Biden has authorized another 15 million barrels of draw against that SPR here through December to complete 180 million barrels withdrawal from it. That will take it to below 400 million barrels of oil. Again, that's going to be about a 40-year low on that. And there's another problem here. It's really the type of oil in that. Okay, so the SPR, the Strategic Petroleum Reserve, holds two types of oil, right? There's medium sour and light sweet crude. Okay, and those are just really the difference in the density and the sulfur content of it. Okay, so the first one there, medium or light, is the density, and then the last, sour or sweet, is the sulfur content. And really why that's important is because refiners like that medium sour type of crude because it's easier to convert into gasoline, right? It's more efficient, costs less to convert, so that's what they use. And while the 180 million barrels that we've taken from the SPR have been almost all medium sour, okay, about 85% of the oil that we've withdrawn from the SPR have been medium sour. And in fact, that has dropped from about 429 million barrels in the SPR in 2017 to just 179 million barrels right now. So what you're thinking here is that we are very much limited, even beyond that 400 million barrels that's still left in the SPR. We're even more limited than that, because if we really want to decrease the amount we want to decrease the price of gasoline through releasing more oil on the market and really making that oil available for conversion into gasoline, we've only got maybe 180 million barrels of that special type of oil that the refiners really like. Okay, if we have to start releasing these that light sweet crude, it's not going to be quite as efficient for the refineries to transform into gasoline. So it's not going to have the same effect at bringing those prices down. So prices are going to go up even more. So now you start to see a picture forming where we're severely depleting these reserves, these usable reserves. And if anything else happens, right, again, geopolitical or otherwise, we just aren't going to have the reserves to meet that kind of demand. And oil prices are going to spike. Not necessarily because we're going to run out of oil, but just because they're going to spike because the idea that we're getting closer and closer to running out of that oil. And now here you might say that with higher oil prices, then the oil companies would just pump more oil, right? It makes sense. If they're making more money off those barrels of oil, then why don't they pump more? But it just doesn't work that way, okay? With a lot of this, oil, with copper that we talked about a couple of weeks ago, with a lot of these commodities, it takes years from exploration to developing a mine or developing an oil field into actual production just to bring that oil to the market. Okay, it can take up to 10 years just to really get an oil field into production. So that means you've got to spend on developing and exploring for that oil years ahead. And what we've seen is since 2014, right? 2014, when we had that first real big oil collapse from $100 a barrel down to about $30 a barrel in 2015. That really changed the thinking in the oil industry and for investors. Okay, the writing was on the wall here, and nobody wants to spend big money to produce oil 10 years out into the future that might not have a demand for it because of that electrification, right? Because of electric cars and solar power and all this other stuff. So we saw that massive drop in the price of oil. Oil industry execs said, "Hey, you know what? We're going to cut back on our exploration, on our field development, all that kind of stuff, because we don't need to be producing this oil in 10 or 15 or 20 years from now. We need to keep the production that we have now, keep on pumping out the oil that we need now." But there's no sense in spending too much to produce oil 10 or 20 years from now. Well, the problem is that's really come back to bite us in the ass, right? You've seen that oil, the spending, this global upstream spending, that's spending, investment capital spending by the oil companies. That's the bars here. That's fallen by about half of what it used to be 2014 and before that. And that has really played on production. Okay, you hear all this stuff about U.S. becoming a net energy exporter and energy independence and all that. And folks, I'm telling you, it is just a lie. We are not producing enough energy or enough oil to meet our own demands. Okay, again, U.S. consuming about 19 million barrels a day in oil. For chemicals, for gasoline, for other uses, 19 million barrels of oil a day. We are only expected to produce about 12.6 million barrels, this year from the U.S. oil producers. So we are not producing enough oil to even meet our own demands, let alone the demands of the rest of the world. Now, to try to get a little bit more production out of the companies, President Biden has committed to the U.S. buying oil and refilling that SPR if oil prices do come back to about $62 to $72 per barrel. So that's a really great, hard floor of support on the price of oil. But it's not likely that it's going to get there, right? Even with the first real recession that we've seen in more than a decade, oil is still at about $85 a barrel, okay? So that's a fear of recession, fear of a global slowdown in China, and oil is still right around $85 a barrel because we just don't have enough. We just don't have that supply, that even with that extra million barrels a day taken out of the SPR and put on the market, there just isn't the supply that we need of oil. And again, it takes years of exploration, field development, and production just to get these fields producing. So this isn't something that's going to happen in any one day. And I think there's a bigger picture here. Even if the price of oil does fall a little bit, then one, you've got you've still got that supply-demand picture. But here, instead of supplying the market, instead of pushing 1 million barrels a day of oil onto the market for that artificially high supply, then not only are we not doing that, we're buying 1 million barrels of oil off of the market, taking it off the market. So you've got a 2 million barrel per day change in the supply-demand picture if oil does come to around $75 a barrel, okay, that the U.S. is going to be buying that oil, taking it off the market, and that's a 2 million barrels of oil per day change. That's like 2 Libya's worth of production. You've also got the stuff coming out of OPEC, right? Instead of supplying the market with more oil, OPEC is actually reducing the supply of oil on the market. They were expected to cut production by about 1 million barrels of oil a day, kind of an answer to that 1 million barrels of oil from the SPR from the U.S. To really keep oil supply at a minimum and keep those prices higher. But what they did, they dropped supply by 2 million barrels of oil. Okay. Really a bombshell, like this article says, a bombshell on the markets really increased the price of oil. The oil was trading right around this point at about $76 a barrel. Oil immediately jumped to $96 a barrel. On this news, it's since leveled back into about 85 range. But that volatility in oil prices, it just shows you the real danger here of depleting the SPR so much, like we have, down to 400 million barrels of oil already, set to reduce even further, and even worse, the type of oil that's left in there is not the best type that we can use. So like we talked about Friday, a lot of these oil companies are set very well for over the next year when oil prices will be high. Most of them are producing oil right around $30 to $40 a barrel on their production costs. So even if oil does come down to that $75 a barrel, $80 a barrel, then these are still going to be cash flow machines. Okay, these are still going to be companies making money, returning that cash to shareholders through dividends, through share buybacks. I do think, over the winter here, if Russia does come to the table to negotiate some kind of a settlement to Ukraine, obviously that will bring the price of oil down, but you still have that longer term forces, that supply demand picture for oil that is going to keep the price up, and it's going to keep it under a very strong floor of support at 75. I think you buy it anywhere in the 70s, and you're going to be extremely happy with that.